Adam McCabe, why is now a good time to be in Asian bonds with the global bond market in such flux?
I think the most important thing about Asian fixed income is that it brings a great deal of diversity to a portfolio. Asian bond markets will, to some extent, follow the developments in global bond markets, but there's a lot going on in Asia. It's a very diverse place. You've got countries as large as China, India, you have Australia as a very solid AAA rated country. A great deal of diversity in the region.
Can you talk about the countries and the credits you like best in the Asia Pacific Income Fund?
I think the Aberdeen Asia Pacific Income Fund has a number of different opportunities that have presented themselves and being exploited by our team. Most importantly and attractively for us is the exposure to India. India is a country that is experiencing quite a substantial turnaround. It is the sweet spot from an emerging market perspective. There's a real chance that the sovereign's country risk premium, the inflation risk premium, can be broken, particularly with the efforts of Narendra Modi and indeed Raghuram Rajan as the central bank. Together, they have every chance of being credible and successful and unlocking that value.
What about China slowing? Because when the U.S. slows down, it affects the entire world. One would think that China slowing would have a serious impact on the entire region.
Well, I think China's slowing is definitely and has an impact on the region. There's no question of that. However, a slowing China is in the interest of the world. China can no longer afford to grow at 10, 12% at breakneck speeds. It needs to be very stable. And indeed, what we're seeing is a transition of China away from an investment-led economy to one that's more driven by consumption. That's positive for the world in the longer term.
China's stock market is on a tremendous run. There's a lot of fears that it could break soon. If it does break, will that send people into bonds, or will it send people screaming away from China entirely?
Well, I think the thing about the domestic equity market is, and indeed the bond market in China, is that it's owned primarily by domestic investors, and they can't really leave China. The reality is that the Chinese People's Bank of China, the central bank, are really proactive in managing liquidity in the bond market, and that gives us some hope and some confidence that the bond market will remain very well supported, notwithstanding what happens in the equity market.
And is the rest of the world underinvested in Chinese bonds? Are they underrepresented in the indexes as well?
Oh, of course. China has very little representation in people's portfolios. Obviously, the capital account is very restricted, so people can't easily gain exposure to China. They can't easily gain exposure to places like India as well. But in the case of China, there is every opportunity that the upcoming review by the IMF about the special drawing rights, that there is an inclusion of China in those rights. And that will lead to vast changes in the way people think about allocating their money. The capital account will open, and indeed China will emerge as a destination.
And then finally, if and when the Federal Reserve over here in America raises interest rates, how will this affect Asian bonds? Because traditionally, when our rates go higher over here, it hits emerging markets the hardest.
It does. However, in Asia, one of the things that's very important to keep in mind is that there is a large pool of domestic savings. And with that domestic savings comes the demand for duration, the demand for interest rate risk. And really what we see is the dominance of domestic investors, and that's likely to remain, come what may, with respect to the US and the US Federal Reserve.
All right. Thanks a lot, Adam.
Thank you very much.
And thank you for watching The Street.